I don't want to give up my low interest rate. I don't want to give up my 3.5%, my 4.5% interest rate to sell my house or to refinance my home. I want to keep that interest rate. And it's a great argument. That is those rates we'll probably never ever see again. Or if we do, we're going to get close, but maybe we'll never get to the threes again. Certainly probably never get to the twos again. I don't want to give up that interest rate. I hear that a lot from people these days. But there's more to the story. When we're talking about selling our home, when we're talking about staying in our home, a lot of people today have accumulated more debts than we've had in the past. I mean, the prime rate has gone up. Interest rate on credit cards have gone up a lot. Interest rates on car loans have gone up. Home equity lines of credit, those have gone up. People are starting to accumulate more debt. And oftentimes it makes more sense to use the equity in home to pay off those debts. And I want to show you what I mean by that. Because remember, when you write a check each month to pay your mortgage, you're not writing an interest rate on that check, you're writing a dollar amount. So it's about the dollars, it's about the cash flow. All right, so I'm going to use an example here. Let's assume that we bought a house back in 2019. We paid $600,000 for it. We've refinanced since then. We've got a nice interest rate at 3.75% interest rate, and we've got a nice monthly mortgage payment here going on our home that we don't want to lose. We're paying $1,730 a month on our principal and interest. Okay, but let's also assume that now we've accumulated some other debts. Okay, we've got some credit cards, we've got a car loan, we've got a home equity line of credit. And now that all adds up to $128,000 of total debt. And we're paying $31.56 a month on servicing that debt. Now we may say, I don't want to give up my interest rate on my car or my home loan. But in the meantime, we're paying a lot of money on this debt. So let's take a look at what it looks like to do a cash out refinance. If we were to take a higher interest rate, a market rate today, roll in all the fees into the loan for doing the loan, we're probably gonna have to pay some points to buy it down as of this point right now. We pay off those other debts, we're gonna improve our cash flow by $1,625 a month. Remember, those are real dollars. Just by paying off those other debts and leveraging the equity that we've earned in our home over the last few years. But here it gets even better. What if we take that $1,625 a month that we've saved and we apply it to our mortgage, we prepay our mortgage? If we do that, we are now gonna pay off our mortgage in 13 years. We've now saved 15 years and 5 months off of our last mortgage that we refinanced a couple years ago. And we're going to now build our net worth. We're going to increase our net worth by $243,000 over that time period, just through amortization and appreciation. So let's not just think about, man, I've got a great interest rate. That's awesome that we do. But let's take a look at our whole financial structure. And maybe it makes sense to reallocate some of our equity and use that, because cash flow is king. If you have questions about your particular scenario, let's take a look at it. Let's see if maybe this might benefit you. Give us a call. Let us know how we can help.